Well, we are an Iberian firm. We cover Portugal and Spain. Originally we are based in Madrid, and then we opened in Lisbon. We have presence in South America and also here in London. And we have a big real estate department, and we expect to be a contributor to enhance the Iberian real estate market as you see it, and that's it.
Great, thank you. Paulo.
Yeah, Meyer Bergman is a pan-European fund management and investment company. We specialize in value-add acquisitions of retail projects, all classes of retail assets, high street assets, shopping centres, retail parks, outlet villages, mixed-use buildings with a strong retail component.
Great.
And we have been active in Iberia since the beginning of 2013. Mm-hmm. We have a total 4 billion euros of assets under management, and in Europe, I think in Iberia we have acquired roughly 500 million euros of product.
Okay, good. Let's start with you, Paulo. I mean, it still looks like it's a sustained kind of low growth environment. I mean, I'm interested to see, and we'll dig down a bit that shortly in terms of the bond yields and what that might have. Do you still think, let's say, over the next 6 to 12 months, so looking forward, over the second half of this year and into next year, that we're going to be in the same kind of economic picture? And what sort of influence do you think that will have in terms of the real estate in Iberia?
It certainly looks like that. I think we won't see an end to quantitative easing anytime soon. That will probably determine bond yields, and as such it will determine the amount of money which is invested in real estate. We are seeing, I wouldn't say abnormal, but enormous amounts of money being invested in real estate precisely because bond yields are quite low and have been extraordinarily low. So I think the main shift we will see in real estate investment allocated to Europe in general and to Iberia in particular will be determined by factors which are pretty much not related to real estate itself, but to the spread between bond yields and property yields. And I don't see that changing anywhere in the next year or so, I would say.
Okay, good. And João, just in terms of the political risk side, obviously a lot of the discussions that we've had recently have focused on political risk. Even in Pravada yesterday, where the big political risk was the fact that they hadn't yet organised a government, and when would that happen? But what's your sense of political risk in Iberia, Spain, Portugal? How do you see that? Do you think now that we've gone through the French elections and the Dutch elections and those things that kind of risk side of it is now viewed much less in terms of international investors? What's your view?
Can I just say that I was in another real estate event yesterday, when people started discussing political risk in France, Germany, Holland, and now everyone realized after that event that the biggest sources of political risk in the Western world are the UK and the US.
True. Well, regarding Portugal, we started 2 years ago. We started by having a left-wing coalition, which was a case study in Europe that sustains the current government. And at the beginning, at inception, I may confess that I was a little bit concerned about the outlook that has caused externally, and everyone in Portugal was a little bit concerned about how would this work, because it's the first time that you have a left-wing, the communists and the left-wing party supporting the government. This is a case study in Portugal, and I think it's starting to be also it raised some thoughts also in Spain in that direction. But the fact is 2 years have gone, and we see that they have made it. They have made it. They have managed to stabilize politically the country. We have two parts of the country separated. The right, the former government that basically won the election, by the way, but has not succeeded to create a government, and we had the country then divided. But now it's unanimous. The country is growing. The results are there. It's mathematics. I'm not joking. It is not to doubt, and the fundamentals are there, And so I think the trust, but you may attest that or not.
No, but it's a market-driven. It's the. No, I don't need it. I've got enough. No, it is actually extraordinary what's happened, and we all come round to agreeing that it's actually, to the surprise of all, the policies which the centre-left government has implemented are working, in the sense that they're pumping more money back into the economy. They reversed some of the austerity measures, which of course was about time, because the people had austerity for 3-4 years, and of course they had some wind in the back as well. I mean, generally economic climate, I think, improved. The tourism, of course, as a result of all the events in the Mediterranean basin, helped a lot. So it's a combination of luck and cleverness, I think.
Okay, good. And Reno, I mean, Paulo mentioned Brexit and the fact that in the UK was causing a significant amount of problems. What's your sense in terms of whether that's impacted on capital flows coming from the UK into other parts of continental Europe? Is it more likely to increase it? Is it less likely? Are you seeing anything in the market at the moment in terms of specifically UK-dominated capital coming in?
Not so much UK-dominated. What we are seeing has been an important increase in terms of continental inflows into Spain. So if you look at the markets about 3 years ago, continental European investment was about 9 or 10%. That's now increased as of last year to over 20%. So we're seeing obviously more interest in Spain. I think, for a number of factors, growth. I think at the same time Brexit has had an impact to a certain extent. We felt it, in closing a few deals at the time Brexit took place, the first phase, and we had to put them on hold for a month. But I think, UK funds coming in, new players, not as much, but continental, money coming in, we're seeing more of that coming through.
Okay, good.
An important point, just in a personal opinion, but I think other people in the room agree with me. I think when you look at the market 3 years ago, people were anticipating rental growth, but it just wasn't the right time. I mean, we're coming out of recession. Unemployment was 24-25%. There wasn't enough confidence in terms of, people to take more space to invest in their real estate. I think now we've got a government, which is an important factor, which does help in Latin countries. We are seeing, on the back of the growth, we're seeing more confidence moving forward. And as a result, I think now's the time we're going to start seeing rental growth, but not over across all the sectors and all the buildings. I think it's going to be very much focused, because I think where people make mistakes, they take the overall vacancy rates and they think that's the vacancy rate for a country. When you actually delve deeper, you actually realise a lot of the stock, at least in Spain, I would imagine Portugal as well, excuse the expression, is pretty crappy. And it's not what tenants want. Yeah. And therefore we're seeing a real focus on quality real estate, not saying necessarily prime, but quality real estate, and that's where we're going to see the growth moving forward. And I think it's the next 12, 24 months we'll start actually seeing tangible impact on total returns as a result of that.
I think it's similar in Portugal. I know it's difficult to convince the audience that if you see a flat line for 10 years with an economy going through the whole cycle and the rents stay flat, it's difficult to convince a room that rents are going to grow. But they have to. There is no supply of quality stock, and the demand is high. And so the issue, maybe particularly more in Portugal than in Spain, is that with residential prices going through the roof, a lot of the space actually competes, a lot of the office space competes, or a lot of office space competes with residential. So if your average developer or property owner would prefer today to build residential, which is worth twice as much as office space. But mark my words, there will be rental growth in the office sector in Portugal over the next 12 to 24 months.
And in terms of, does that mean, I just want to pick up that point that where you've got some assets that are therefore not up to the standard that international investors are looking for, does that mean that there's a turnaround play there? Are those assets in places where they can be changed, renovated, or changed use? What's the position with those?
City by city, I mean, you could argue it's not just the impact of national government, but the local government. If you take Barcelona as an example, we've seen an important change in terms of posture towards hotel development. We spoke about it earlier. I think we're seeing, and to actually give you exact numbers, over the past, 8 years, we've seen 10% of the office market in Barcelona bought for a conversion to either hotel or residential. 10%. obviously assisted in terms of the vacancy rates, but it's an enormous number. And as Eric said, I mean, you look at the arbitrage between, commercial real estate values and residential values, and a developer here in front of me, there's a big play there. Obviously with hotels now, given the local government posture towards hotels, we're not seeing anything. It's impossible to get the licenses in certain parts of the city. So I think there's a play there, less so in Madrid, given the planning position. But there are options for certain assets, not for all assets. I mean, things have changed. You've got to look at where occupiers want to be. And some of the deals that we did back in 2005, 2006, 2007 on the outskirts of Madrid and Barcelona, we're not going to do again.
And João, in terms of the different cities or the government and regulations in terms of change of use, those kinds of things. So we've heard a bit about the block on hotel development, but in terms of change of use and those kinds of things, how easy, how difficult is that? Is it something that certain cities want to promote and some don't? What's the position?
Well, the uses are, they are basically foreseen in the planning instruments that are applicable to the cities. In the case of Lisbon, the municipal director plan for Lisbon, and the same for Porto, for instance. So the uses are in principle established and may or not vary in light of that. On top of that, what we have seen is rehabilitation moving forward, development mostly in the residential sector, where we have been seeing many investors doing or putting money into rehabilitation projects in the city centers, that are enhanced by the tourism, big flourishing in both the cities. We have been seeing, in Lisbon it's massive. When you compare Lisbon, I'm not sure if you have ever, some of you have, some don't, but Lisbon 2 years ago, it has nothing to do to Lisbon nowadays. It's amazing. It's people complain in Lisbon about the number of tourists arriving into the city because we are not used to that. And this reflects what is the demand that you now have in the city for this type of residential projects. This also helped by the tax environment because we have a golden visa, very good environment, and a non-resident good environment that is currently attracting people from London, mostly ultimately from France, and this is creating a buzz that is also creating value at the residential sector, in the city centers, in the rehabilitation of old buildings that were stopped and that are now moving. I would say that this is a trend.
This is actually an area where you see the two countries going in opposite directions. You see a very pro-business atmosphere in Portugal and the cities in Portugal. And in Spain, especially Madrid and Barcelona, with the change in political color, and not very long ago, you see a massive change in the opposite direction. It's much harder now to get urban planning changes across, changes of use, and a lot of people that bought property, say a year ago, 18 months ago, hoping they will use those planning instruments to deliver their results, are now struggling quite hard.
So a big change, and something that's actually had, that political change has actually had an impact on the market that you're seeing now.
In Spain, yeah.
In Spain, yeah. In Madrid, Barcelona especially. Yeah. Okay. In some other regions too.
Okay, good. And Paulo, just from your point of view, Meyer Bergman obviously investing around the world. How do you see, let's say, the Iberian market, Spain, Portugal, in comparison to the other markets that you're investing in? And are there specifics that you're looking to invest in terms of your strategy for those two markets that are maybe different to the other markets that you're working in?
I'd say, we are an average size firm, so we don't have a lot of pressure to invest very rapidly, so we can choose assets carefully. If we don't invest in Madrid, we can invest in Poland. If we don't invest in Poland, we can invest in the Nordics. So we take our time and we choose. And this is why probably we have bought assets early in the cycle in Spain, and were unable to do that in the last couple of years, mainly because a whole host of new buyers with cost of capital much more interesting than ours were able to take over the market, and they are taking levels of risk that we as a value-add fund would think twice before taking, and you see much more players taking levels of risk, especially urban planning risk, leasing risk, and it's basically taken over the market now. We have been very successful in a very niche section of the market, which is the outlet villages, where we bought 2 outlets in Spain and 2 outlets in Portugal, because we believe in the fundamentals of that specific industry, and we want to increase our exposure to that. In terms of other asset classes, we I think our belief in the rental growth story is there, but it's not as optimistic as possibly other people in the room, especially because those two economies are being driven a lot by tourism and by consumption, and those things do not necessarily materialize in rental growth, especially in the office sector, maybe a bit more on the retail sector. For us, it's been much more about a yield play than a rental growth play, and as such, the window is narrowing rapidly for us in those two markets.
And just, I mean, I saw in the
Can I just
slides...
make a very minor correction, because I don't need the Portuguese economy, the growth and also the slump has actually always been driven by private consumption. That's changed now, and that comes through again in the numbers that were published yesterday. Is that the public spending is actually the growth is slowing. So there is it was 3.2% last year, it's 2% now. And so the economy is less...
In consumption, you mean?
Yes. So the growth is less driven or less dependent on private spending.
And I just wanted to pick up, when we looked at the charts there for retail especially, you saw in Portugal that there was quite a big rental growth in terms of the shopping centres, but not so in terms of high street. What's the position then in terms of the outlet centres? Does that mirror more the shopping centres, or what's the position there?
It's a separate sector. I think that there's much more similarity between outlet rents in Portugal and Spain than there is in high street rents or even shopping centres. In fact, I was amazed to find out that prime shopping centre rents in Spain were once above those of Portugal. I always thought that the Portuguese rents were above, so they certainly were traditionally. But in the outlet sector, it's much more of an international market, and I would say there's more similarity in rents between the two countries.
Okay, great. I wanted to pick up a little bit, João, with you, in terms of obviously one of the key drivers for liquidity and growth, and really did kickstart the Spanish real estate markets, was when the bad banks were introduced and also the SOCIMIs were introduced. Now, I don't know when that's going to happen, but there's discussion about certainly a bad bank in Portugal, and also encouraging views in terms of REIT regimes. What's the position there in terms of the Portuguese market, and will that have a similar impact? Sorry, about 10 questions already.
Starting with the SOCIMI. Basically, in the budget approved for 2015, by the former government, meaning by the right-wing coalition that was in the government before this one, they have approved the budget foreseeing the creation of the Portuguese SOCIMI, so to speak, Portuguese REITs. And this was approved as something to be designed, developed and approved by the government. Then the government fell apart. And these new left-wing parties have taken over, and they have been making publicity to the fact that they will effectively produce this legislation, that they are effectively keen on taking advantage of the good example in Spain. But so far, we have not seen the legislation coming into force. I think it's obviously a good measure to enhance the real estate market in Portugal, giving the similarities with Spain. I think it's synonymous of liquidity, of new investment, etc. That goes without saying. But I'm a little bit concerned about that, because ultimately this would need to be approved by the parliament, and the parliament meaning left-wing parties, and this meaning ultimately that we would need to have their backing of these measures. And they are being promised by the Prime Minister lately on very recent occasions, but I'm not seeing so far evolution on that. I expect that to come up until the end of the year, but let's see. On the bad bank, bad bank. After the good experiences with the NAMA in 2009 and with Sareb in 2012 here in Spain, the Portuguese economy has not taken the advantage of using the Troika support when they could have it in order to create this same vehicle. By then, it would be easier to create the vehicle because the constraints would not be the same as we have now. Notably, public state aid is no longer allowed in the same way as it was back then. Having said that, the government is saying that they are planning and discussing not only with the Portugal Central Bank but also with the European Commission the creation of I think this is public information. You must just by reading the papers you get that a platform for management of NPLs that are currently in the balance sheet of all the banks. Well, this is a massive for Portugal because we are talking about 3.5 billion of NPLs inside the balance sheet. So it's a big hurdle to take care of. What will be the mechanism? First, will it see the light of the day? That's what the government is saying. That's what we need. We the country in principle need to enhance the possibility of putting us above the rating level that we are now. That this is something that they have been publicizing, so I'm just saying public information. On top of that, we may have the model of Spain and Ireland. We may have, which is basically take all the NPLs out into a special purpose vehicle created for that purpose. This model is well known in Spain and in Ireland. It has worked, it is working, but it entails public back guarantee to secure payment, which is something that back in 2012 was more possible, and now it's constrained. So we need to find the way through it, and the new solutions that have been put in place recently in Italy allowed the creation of an equivalent vehicle that was a mixture between the NAM and Sareb and the injection of money or the capitalization of banks. I'm not sure about what would be the solution in Portugal, but according to the words of the Prime Minister, it's a Portuguese-style solution. It will not be an Irish, nor a Spanish, nor an Italian. It will be a mixture. This is what I can tell you, but that's it.
Okay, good. Mentioned a little bit in terms of the logistics and industrial in the presentation, but what's happening in terms of e-commerce there? How much of a driver is it for the market? How much take-up is there? What's the absorption at the moment in terms of the market for e-commerce?
We're seeing, for me, we're seeing activity. It's improving every year. I mean, you look at the players coming in. Amazon have just taken their Southern European base to Barcelona, massive warehouse just out by the airport. I still think we've got a long way to go, particularly because of the dearth of quality space. Bear in mind we've got two important ports on the Med with Valente and Barcelona. So I think it's a future play for me. I agree with you. I think at the moment we've suffered in terms of the quality of the real estate moving forward. The occupiers have. That said, if you look at general logistics demands in Spain, particularly Barcelona, all-time record levels. All-time. We've seen growth, which has been sustainable growth for the past 2 or 3 years. So I'm positive, but I think I'm more positive, more short, medium term rather than short term.
Okay, good.
We had sorry.
Go ahead.
We in Portugal we organised a Future of Real Estate conference last week, and one of our speakers was a DHL person, and it's amazing what's going on in that space in terms of robotization, drones, the future of self-driving trucks, etc. So it's I think a lot actually will happen in that sector, and also not just huge Amazon warehouses near airports, but also much smaller turnaround.
Last mile.
Yeah, that last mile, exactly, the famous last mile distribution, which creates a need for much smaller spaces in city centres.
So one of the indirect impacts of internet retailing, which is still compared to other European countries quite low in Iberia, and that has to do with cultural effects, has to do with the penetration of credit cards, whatever. It is growing, and it hasn't having an impact indirectly on another retail sector, real estate sector, which is retail. Because it's driving the expansion strategies of some of the most important international brands. I think you will see that some secondary locations, not only high streets but shopping centres, will suffer because some of the most important brands are now focusing on real enormous stores in very important locations. They will make them their high street, their most important shops, and some of the secondary locations, some of the smaller units will be sacrificed. And this is an direct impact of internet retailing and will hurt secondary locations both in high streets and shopping centres.
And does that, I mean, there have been a lot of discussions in the retail world especially about creating destinations, hospitality, putting food and beverage at the heart of those shopping centres so that you breathe kind of new life into them and change the tenant mix but also the experience. How important is that for the Spanish market? And does that mean that that's going to be able to adequately offset, I guess, what's happening with e-commerce? What's your sense of that, Paulo?
Well, shopping centre owners are definitely worrying and taking care about that. I mean, there's not a lot of stock coming to the market because, as you are aware, development has pretty much been frozen over the last 5 years. I think possibilities of having further shopping centre development in Portugal are quite limited, not only because of the way the market is occupied, but also because of the banks and the lack of financing. Spain may be a bit better, but not too much better. So it's basically a play where the most important landlords, and some of them are international landlords, that have the ability to develop internet platforms and take a view in terms of what internet retailing impacts the shopping centres and how you can deal with that by creating experiences in your assets. The most important landlords are certainly taking care of that, worrying about that.
Okay, good. I mean, I'll pick up the point about development actually, because you mentioned obviously in the presentation that it was very, very difficult to get any kind of bank financing for that. So does that mean equity capital is therefore king in that sense, especially when you're looking at the residential markets where you can then come in, use your equity in order to make that development when nobody else can come into the market?
Let me just clarify, when I mentioned about the difficulty in terms of getting bank finance, I'm really referring to commercial developments. Correct me here, but what we're seeing in terms of the residential market, that is available, obviously subject to pre-sales. But my reference is really to the commercial market rather than the residential market across the board. And there we're seeing difficulty. We can get project finance, but we're struggling in terms of getting acquisition finance for the initial purchase. And as a result, what we're trying to do with international capital, for two reasons. First of all, we believe in occupancy markets moving forward for certain locations. We're looking for a spread in terms of a spread over the stabilised yield level. We believe in the potential in terms of pre-letting. So with certain international funds, for the right product, we're actually putting offers out to forward fund. We believe that we're getting a margin. I look back at the last cycle, I remember doing forward funding deals back in 2004-2005 with margins of about 125, 150 points. That eroded to 25, 30 points in 2007, and we got on the market then. We're seeing the same cycle now. So we think we've got to be early to do it well and get the right returns for our investors. But I definitely think for certain locations, it's an option for investors to take a position in the market. Not an easy one, because you're going to take on more commercial risk at the end of the day, but it's definitely there. We can't forget the system is the cost of capital is actually relatively high. It starts at 10, 11% up to 15%. We've seen new continental money come to the market, essentially value add core plus with cheaper money and more competitive moving forward. So I think they were definitely the catalyst for the change. I remember doing a deal with this man here in Serrano, which is the Oxford Street in Madrid, back in May 2013. We managed to structure a deal, but we struggled to sell that asset. It wasn't easy. A year afterwards, we had multiple bids for more secondary real estate. So there's no question at all. They have been a catalyst. They've been very positive for the market. But I think overall, as the market evolves, things change. I think it's normal to a greater extent. The market is now perceived for me as being more value add, given the rental play or the rental growth play potentially, and core plus. But
I think we're ignoring a class of investors we haven't discussed yet, which is the private wealth, family offices. It's them very much who are very, very keen buyers for some of the assets, particularly high street retail. And it's about wealth preservation. It's as my colleague David Hutchings tends to say, it's not about return on capital, it's return of capital. And I think that's very much a theme at that level.
Sorry, and what sort of ticket sizes do you typically see them?
In Portugal, they're relatively small, I would say, between sort of 5 and 15 I gather in Spain, which is there's much more capital available, much more wealth in Spain, I guess.
We've seen up to about 40 million, but at the same time as the private high net worth individuals are seeing the insurance companies and pension funds actually take very strong positions at very aggressive yield levels. And the idea now of big Spanish pension companies to actually double their property holdings, as you quite rightly mentioned earlier.
And so when we're talking about that, is that domestic capital including the high net worths, or are you talking about international high net worths coming and playing in those markets?
Essentially domestic and...
Well, no, in my case, in Portugal, it's more international.
In Spain, it's more domestic.
Yeah.
Okay, good. I just wanted to do just something quickly in terms of the cities and secondary locations. Obviously, secondary locations becoming much more popular as the market moves out, along with alternative assets. What's your sense? Is that viable for international investors? If so, where would you go? Logistics, I guess. Hotels, maybe. Office, I guess. No. But what's your sense of that? Which markets you can play in as an international? Yeah. Anyone?
You go ahead.
No, you go ahead.
I was just saying, I think it depends on what your perception is at the point where you are in the cycle. I think one main difference between this cycle and the last cycle is that I remember 2006, 2007, anything sold anywhere. And yields for, I wouldn't call even secondaries, tertiary cities were very close to yields for important cities. And that is completely changed now. So there's a perception of risk, and people are much more skeptical about secondary locations, both for offices, retail, all sorts of assets. So, and again, if the cycle changes, or there are hints that it will start to change, those will be the first locations hit by liquidity. So I think there's a major difference between this cycle and the last cycle. So I would be much more skeptical about secondary locations today than I would be in 2007, let's say.
Next time to go to the capital, and this is a question for Paulo from last time. Actually, my initial question was around, and thanks for just bringing up the logistics sector into discussion, was mainly about...
Hi, my name is João, and EQ Hotels. We are actually a hotel owner-operator. You've focused on hotels as one of the potential alternative markets that actually could have some growth coming down the line. We work with institutional capital, and obviously data, being an operating business, data is very important to us. And in particular, I think in Portugal, we found that actually the opacity of the market in terms of that data, transaction information, comparable transaction information, yield data, being able to rely on those yields, etc., has been quite a challenge for us when we're actually trying to do our sort of DD and trying to find value.
Yeah.
Open to the panel, please. Your views, if you will.
Yeah, no, it's a fair point. Well, firstly, I don't think there have been that many transactions in Portugal, and the transactions that there have been mainly with operators, or operators who acquired them. The big one, of course, being the Tivoli chain, which was bought by the Thai Miner Group last year. And yes, I too would like to have insight into the full detail of those transactions to understand what the underlying factors were, but I haven't. All I can say is that Cushman now has a specialized hotel division as of the beginning of this year, so we're working on it. But I understand what you mean. There's a lot of potential interest in hotels from institutions, but actually institutional products it comes very, it doesn't come to the market very often.
Yeah, it's scarce.
I think there's a bit more transparency in Spain, perhaps not too much. I mean, we work closely, we run the hotel division from London as a cross-border team together with Portugal now. We've been lucky in the sense we've valued or refinanced all of hotels, Villa Magna, the Mandarin, Intercontinental in Madrid. We worked on the Four Seasons, so we've got more information in terms of RevPAR, where we are. That said, I'd like to see more data. It's not easy, not at all.
Okay, good. We've got another question here.
Yeah, this is Paul Wilson, a former investor in Portugal and Spain. Just sort of a question really for Eric and João for that matter. Is there any move toward changing the tax rules for non-Portuguese resident banks lending in Portugal?
Yeah, that's a good point. João?
I like the way you pass that straight over it.
It's called the hospital pass, isn't it?
My honest answer is I don't know.
I heard something about that, but I don't have any further intel. That has been discussed also I heard court discussions on that, but I don't have any intel on new legislation coming forward on that, so I cannot. As far as I know, no.
Okay, we've got one more here.
Hello, it's Victoria Orman from Samuels Investment Management. I have two questions, hopefully quick, one related a bit to the other. The first is, we've talked about most of the different sectors, and we've talked about retail, high street retail, but we haven't really talked about retail warehouses. Now, is that because there isn't the liquidity? Is it because of the competition of shopping centres and big box, something else? My second question is related again to e-commerce and unemployment. Are there any linkages with having higher levels of youth unemployment potentially constraining e-commerce?
Well, youth unemployment in Portugal is much less of an issue, I think, than in Spain. So I'm not sure that there is that immediate link. On retail warehousing, you're right. We haven't talked about that. Again, I speak for Portugal. It's not a very developed asset class in Portugal. Because our shopping centres are so successful and have been going for 25 years, a lot of your typical retail warehouse, retail box operators are actually either within or just outside of the existing shopping centres. We worked from start to finish on the first retail park in Portugal in Sintra, which we bought the site for Sonai and Miller Developments, who teamed up to develop retail warehousing in Portugal in 2000, and to our dismay, it was actually, we found it very difficult to lease because all the operators were already in or outside the shopping centres in the region, or clustered together in as sort of independent clusters. So it hasn't been a great success story also from a consumer point of view. I mean, the consumer has so much other choice that retail parks aren't the obvious place to go shopping. Having said that, there are a number of successful retail parks, but much less so, for example, than in Spain or in the UK.
I think you have a very different situation in the two countries. A very healthy market in Spain, I'd say, with consistent demand from operators, relatively good rents and sustainable rents. Whereas in Portugal, you first had a wave of occupiers that were really shopping centre occupiers, and then you had a wave of Portuguese retailers that came out of the blue, expanded into everywhere, and collapsed as quickly as they expanded. So what you see in Portuguese retail parks is now probably difficulty in finding new operators, and if anything, a downward pressure on rents, not an upward pressure on rents. So very difficult situation across the two countries.
Hi, Sam Ward from Merrill Lynch. A question for the Cushman guys, I think, but then maybe also I'd be interested in a comment from maybe one of the Paulos on it as well. You showed a forecast of yields, using Prime Madrid as a proxy, but basically flat over, say, 3 years, getting to effectively then a zero risk premium versus a Spanish 10-year bond by 2020. And you talked as well about a sort of 8 to 10% total return expectation, let's say this year, but that's driven by rental growth. I mean, at the moment, you're paying that yield in the expectation of that rental growth. How confident are you that a purchaser in 2020, having had, say, 3 years of this type of rental growth, is still going to then accept a kind of zero risk premium? What sort of rental growth outlook must you then assume forward from 2020 to...
That was clear from the graph before. We're assuming 2020, 2021, 2022, we will see yields move out. We will see that, Perhaps from the graph it wasn't that clear. I think it's between 40 and 80 points. Difficult to say. It might be more. I think what's clear moving forward is that living in this bubble of Spanish bonds at 1.5% is not going to continue indefinitely. So we are conscious of that, and when we're modelling our cash flows, we are including a variation in terms of the exit strategy. When we're looking at quality real estate, we look at the vacancy rates, and I spoke earlier, if I actually look at Class A office buildings in Madrid, Barcelona, we're actually a true vacancy rate of about 3 to 4%. So I think short term we'll see that rental growth. We think it will be sustainable short term, but not at 7-8%. I think it's going to fall to about 2 to 3%. But I think we are trying to be realistic as best we can as to investor perceptions and the cost of capital. But I think as the cycle moves on as well, we'll see if the product's available, a lower cost of capital coming in. I think at the moment we're saying it's more core plus, value add. One would hope, and you look back at the last cycle, which was very different, it was far more core than core plus and value add. So it's just as we move through the cycle, we hope, we trust, particularly Madrid, we believe is perhaps not a tier 1 city, but it's at the top of the tier 2. So we still see liquidity there, in the medium long term.
Okay, great. We're just about at the end of the time, but you've got 20 seconds each to tell me where we should invest. You can choose whether it's your own personal money. You can choose whether you're going to go with what your firm would do. But what are your investment tips? I also like the idea of the Cushman guys, which sounds to me as though it could win Britain's Got Talent. I think that's good.
Residential in the city centres of Lisbon or Porto for tourism purposes or hotels.
Okay, Paulo.
Strong retail shopping centres dominant shopping centres in secondary locations, Spain and Portugal. Offices that were developed and let around 2011-2012 with 5-year leases that are just about to expire. And probably some fringe sectors like student housing, senior residence, that kind of thing.
Okay, good.
It's not easy to be original anymore after all this. It's Lisbon High Street retail, Lisbon and Porto offices, and resi conversions.
Okay,
got this.
No, is that
Barcelona offices. I think, given the tight profile of groups taking space now, we're going to see some strong growth. Bearing in mind, we're a very limited city. Logistics, more as a medium-term play, and I think short-term residential.
I'd just like to say thank you for you, and if you could join me in thanking the panel, that would be great.